Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Morning. Good to be here.
We've got quite a stack in front of us today. We're looking at insights from CNBC, MarketWatch, Reuters, Yahoo Finance, Bloomberg, the whole lot.
Yep, plenty to get through.
And our mission, like always, is to be your shortcut. We'll dig deep into these articles, pull out the really key stuff, the insights you need to know.
Exactly. We're going to unpack the latest on U.S.-China trade, definitely. Market reactions too, stocks, bonds, gold, even crypto.
Plus some key economic data releases everyone's watching, and some, frankly, pretty fascinating news from big tech, AI, quantum computing. It's all in the mix.
It's a complex web, for sure. But hopefully by the end of this, you'll have a clearer picture of what's really driving things.
Okay, let's unpack this then, starting with the latest on U.S.-China trade. Where do we begin?
Right. Well, the big development happened in London. High-level talks between U.S. and Chinese officials. Sources like CNBC and MarketWatch were all over this.
Okay, London talks. Who is actually there?
Well, the reports mentioned U.S. Commerce Secretary Howard Lutnick and U.S. Trade Representative Jansen Greer. They apparently stayed on for more detailed negotiations.
And Treasury Secretary Besant.
He was there initially, yeah, but sources said he had to leave early. Something about testifying before Congress back in D.C.
Gotcha. So after all this talking, what actually came out of it? Did they, move the needle on that Geneva consensus thing?
They did, sort of. MarketWatch and Bloomberg are calling the outcome a framework agreement. The idea is to implement that Geneva consensus we talked about before, the temporary tariff rollback.
A framework.
Yeah, but don't get too excited just yet. It doesn't sound like a massive breakthrough. Stephen Innes over at SPI Asset Management, he was quoted in MarketWatch saying it's less a major step, more of a placeholder.
Huh. A placeholder.
Yeah.
Doesn't exactly scream deal done, does it? What's actually in this proposed framework, according to the reports?
So, based on reporting from CNBC and Bloomberg, the core idea seems to be a swap. The U.S. might ease up on some export controls.
Which ones?
Specifically targeting advanced technology, it seems. And in return, China would free up its exports of key rare earth minerals.
Okay, easing tech controls for rare earths. That definitely sounds strategic. But this isn't a done deal yet, right?
No, absolutely not.
Yeah.
Needs the green light. Both CNBC and MarketWatch were clear this framework needs approval from President Trump and President Xi Jinping.
So why should you, our listener, really pay attention to this London development? What's the significance?
Well, it matters because, as Reuters and Bloomberg pointed out, these talks came after both sides were basically accusing each other of breaking that earlier Geneva deal.
Right, I remember that. U.S. saying China blocked magnets, China had its own issues.
Exactly.
Yeah.
So reaching any kind of framework now, even if it's just a placeholder, signals they want to keep the truce going, prevent things from really blowing up again. One Reuters headline called it getting the truce back on track.
Okay, got it. So that's the high-level negotiation picture. But let's shift gears. What about the tariffs that are already hitting businesses? Reuters had a piece that sounded, well, pretty grim about the situation on the ground in China.
Oh, it really did. That Reuters analysis painted a tough picture for certain Chinese exporters. Think industries like kitchen appliances, medical devices.
Yeah.
The report suggests many firms are actually selling to U.S. clients at a loss, just to hold on to the business, keep those orders flowing.
Selling at a loss. How is that even sustainable?
It's not, really. The tariffs are still high. Reuters mentioned 30 points higher than last year. Competition is just brutal, so they have basically zero leverage to raise prices.
Wow. There was a quote in that piece that really stuck with me.
Oh, you mean Jackie Wren, the factory owner?
Yeah.
His quote was stark. He said, "If an exporter does not take such orders, you will die immediately." So people think it's better to die slowly.
Better to die slowly. Oh, that really says it all about the pressure they're under. And it wasn't just price, it was payment terms, too.
Absolutely. Reuters went into detail. U.S. buyers are apparently playing hardball, demanding much tougher terms.
Like what?
Like no advance deposits.
Yeah.
And delaying payments significantly. We're talking 120, sometimes even 180 days after the goods are delivered.
180 days? That must just wreck cash flow for these companies.
Oh, totally. Reuters had this anecdote from Candace Lee, a marketing manager at a medical device maker. She said her company hadn't paid wages for 2 months.
2 months?
Yeah, because they just couldn't manage the cash flow with these crazy payment delays. A quarter of their staff had already left. Her quote was something like, "They have us under their thumb. It's really hard to do business now. And the company can't even manage to pay wages. It's really hard to keep the company running."
Just brutal examples of the real-world impact. Is this affecting all Chinese exporters, or is it more concentrated?
It's not universal, according to Reuters. The report makes it clear the pain is worst for smaller companies, especially in sectors that aren't seen as essential. Things like Christmas decorations or industries where buyers can easily find suppliers elsewhere, household appliances, some electronics.
So the bigger picture numbers might look okay, but underneath.
Right. Reuters cited official data showing overall industrial profits for bigger firms still grew a bit, and China's export growth looked okay in May, like 4.8%. But the analysis argues that headline number hides this intense competition that's just crushing profitability for many.
So what's the analyst takeaway from all this? What does it mean for the trade talks?
Well, analysts quoted by Reuters, like Ziwu Chen and Alicia Garcia Herrero, seem to agree the current tariffs are hurting China. Chen sees it as a bargaining chip for the U.S., but Garcia Herrero added some caution. She said it's maybe not a big card for the U.S., partly because the U.S. has its own worries about inflation and shortages if imports get cut off too much. Plus, she pointed out Beijing seems pretty confident it can handle more economic pain than the U.S. can.
That really clarifies the dynamics there, the leverage and the pain points. Okay, let's connect this back to that London framework again, the potential swap. Elon tech controls for rare earths. Let's dig into why rare earths are such a critical piece here.
Yeah, this is super important because rare earths aren't just another commodity, right? They're strategic.
Yeah.
Sources like CNBC, Reuters, Bloomberg all stress this. We're talking minerals like scandium, hafnium, stuff that's absolutely vital for advanced tech.
Like what kind of tech?
Think clean energy magnets for wind turbines, EV motors, but also crucial stuff for aerospace and defense systems, really high-tech applications.
And China's role in this market is dominant.
Dominant is putting it mildly. CNBC and Reuters use terms like near monopoly, even absolute monopoly, in production and processing.
An absolute monopoly on materials needed for defense, for the green transition. That sounds like a major vulnerability for the U.S. and others.
It really is. CNBC quoted Brendan Clark from Victory Metal saying the world has been asleep while China built this position. For the U.S., even their strategic stockpiles are apparently way short of what defense contractors need long-term.
Wow.
Yeah, and sources like CNBC mentioned the Pentagon actually has a target phase out certain Chinese-made magnets by 2027. It's part of this whole de-risking supply chains effort.
Okay, so China holds this powerful card. And the London framework might involve the U.S. easing tech export controls to get China to loosen its grip on rare earths. What are the strategic implications of that kind of deal?
This is where it gets really strategic. Wendy Cutler, a former top U.S. trade negotiator, commented on LinkedIn, according to Bloomberg. She said the idea of the U.S. trading away export controls here would be unprecedented.
Why unprecedented?
Because those controls are usually justified on national security grounds.
Right.
To keep advanced tech out of the hands of potential rivals. Her point was that if China can use its rare earths dominance to force concessions on, say, chip controls, that sets a really significant precedent. It shows how intertwined trade, tech, and national security have become.
It absolutely connects the dots, the tariff pain, the strategic minerals, the tech competition. Okay, so with all this going on, the shaky truce, the tariff impact, rare earth strategy, how did the markets actually react to the London news?
It was a bit of a mixed bag, actually. Initially, Asia seemed pretty upbeat. CNBC reported gains across the board in the Asia-Pacific region on Wednesday.
Like where specifically?
China's CSI 300 was up, maybe 0.75%. Hong Kong's Hang Seng rose almost 0.8%. South Korea's Kospi jumped over 1.2%, hitting its highest since early 2022. Australia's ASX 200 gained 2%. So clearly some optimism there that talks were at least moving forward.
But that optimism didn't quite translate to the U.S.
Not really, no. Unlike that big jump after the first Geneva deal, U.S. stock futures actually dipped slightly early Wednesday, according to Yahoo Finance and MarketWatch, once the details of this London framework came out.
Interesting difference. What's the bigger context for the U.S. stock market? It's been holding up pretty well, hasn't it?
It really has. MarketWatch and CNBC pointed out the S&P 500 and NASDAQ just finished a 3-day winning streak. The S&P is actually hovering really close to its all-time high, only about, 1.7% off the peak from back in February.
The stocks are near record highs, even with trade worries lingering and a deal that's maybe just a placeholder. What are the market strategists saying? How do they square that?
Well, the strategists quoted in MarketWatch sound pretty cautious. Mark Hackett at Nationwide, for example. He noted the market bounced back fast from the April lows, but maybe that was just lack of selling. Now he thinks it needs real fundamental improvement to go higher.
And the risks he sees.
Things like high valuations, the trade uncertainty we've been talking about, and companies still revising their earnings forecast downward, those are potential headwinds.
Is there another take on why stocks are holding up?
Yeah, Chris Maxey at Wellspire Advisors, also in MarketWatch, suggested it might be investors just feeling less pessimistic about the economy than they were. Sort of a not as bad as feared rally, leading them to move money back into stocks.
And there was another factor mentioned too, wasn't there? Something about layoffs.
Right, CNBC highlighted that. It's a bit counterintuitive, but companies have been speeding up layoffs this year. Google, Paramount, Microsoft, Citi, Disney were all mentioned. And sometimes the market actually reacts positively to that, seeing it as cost-cutting that could boost profits per share, even though it signals economic caution.
Okay, so it's a mix. Maybe the economy's not falling off a cliff, investors shifting money, plus this sort of perverse boost from cost-cutting, all happening while those fundamental concerns are still there. A complex brew.
Definitely. Lots of cross-currents shaping the market right now.
Okay, if stocks are complex, let's turn to bonds. Sources suggest the bond market might be telling a slightly different story, especially about confidence in U.S. fiscal policy. What's happening with Treasury yields?
Yeah, CNBC reported recently that both the 10-year and 30-year Treasury yields were ticking up slightly. The 10-year was around 4.49%, the 30-year closer to 4.95%.
Just inching higher. How are people interpreting that?
Well, there's a pretty sharp take in a MarketWatch opinion piece by Damaikuza Moyo. She basically argued these rising yields signal a deep loss of confidence in U.S. economic policymaking.
Wow, strong words. Loss of confidence. What specific reasons did she cite?
The MarketWatch piece listed several concerns about potential legislation, like President Trump's proposed One Big Beautiful Bill Act, which some projections say could add trillions to the deficit and debt.
Trillions.
Yeah, like $3.8 trillion to the deficit, $3.3 trillion to the debt over 10 years, according to those estimates.
Yeah.
Plus, the overall fiscal path is seen as unsustainable deficit, already near $1.9 trillion, debt heading towards 135% of GDP. And then there are worries about Social Security and Medicare, potential insolvency down the road.
Those are big domestic issues. Any international factors mentioned?
Oh, yeah. The MarketWatch article pointed to Moody's recent downgrade of U.S. sovereign debt, that AI1 rating, as underscoring these fiscal problems. And then there's the geopolitical angle, rivals like China holding significant amounts of U.S. debt, which gives them leverage. That adds another layer of uncertainty.
So deficit spending, debt levels, entitlement worries, credit downgrades, geopolitical leverage. Anything else driving this supposed lack of confidence?
Well, there's the fear that potential tax cuts might actually hurt revenue and push yields even higher. That makes borrowing more expensive for the government and could, tie the Fed's hands when it comes to cutting rates. Plus, the tariffs we discussed earlier, they're seen as a drag on the global economy too. The IMF even lowered its growth forecast, citing trade tensions. All this uncertainty can make investors demand higher yields.
That really paints a picture of some significant fiscal headwinds, at least from that perspective.
It does. And according to Moyo's piece in MarketWatch, all these trends together raise some pretty fundamental questions about the dollar's long-term future as the world's main reserve currency, and whether treasuries will keep being seen as the ultimate risk-free asset. They even mentioned weaker-than-expected demand at a recent treasury auction as possible evidence.
Okay, so if doubts are creeping in about traditional safe havens like treasuries and the dollar, where are investors putting their money instead?
That's a key part of the story. MarketWatch and Yahoo Finance both talked about investors increasingly looking at alternatives. Gold, obviously, is the classic one.
Right, gold's been strong.
It has. Yahoo Finance noted gold prices actually edged up even after that U.S.-China trade framework news, which maybe suggests the market isn't totally convinced it's a solid fix. And MarketWatch pointed out gold has surged this year alongside Trump's tariff moves and geopolitical shifts. It's acting like that classic hedge against uncertainty and inflation.
And the other alternative mentioned was crypto.
Yep, crypto's definitely part of the conversation now as a potential safe haven. MarketWatch highlighted the huge inflows into Bitcoin ETFs, over $9 billion in just over a month. That makes it way easier for traditional investors worried about inflation or fiscal issues to allocate some capital to digital assets.
And wasn't there an interesting point about the Trump administration's stance on crypto potentially affecting the dollar?
Yeah, that was in MarketWatch too. It's kind of ironic. But the piece suggested that moves by the Trump administration to sort of legitimize crypto might actually be speeding up the shift away from dollar dominance. By making crypto seem more validated, it could encourage people to look for and use alternatives to the dollar system.
So gold and crypto are catching flows amid this complex mix of trade, debt, and dollar questions. Okay, one more critical piece influencing markets this week. Economic data. What's the big report everyone's waiting for?
That would be the U.S. Consumer Price Index, the CPI report for May.
Yeah.
It's due out today, Wednesday morning. CNBC, Yahoo Finance, MarketWatch, they all flagged this as a really important one.
And what are economists expecting?
The consensus forecast, cited by Dow Jones and reported in CNBC and MarketWatch, is for a 0.2% increase month over month in May. Year over year, headline CPI is expected up slightly, maybe 2.4%. And core CPI, that's the one stripping out food and energy, is forecast at 2.9% year over year, up a tick from April.
Why is the CPI number so crucial right now?
Well, as MarketWatch explained, if inflation comes in hotter than expected, that could really spook investors who are already nervous about price pressures. And critically, it could heavily influence what the Federal Reserve decides to do with interest rates going forward.
And any link back to the tariffs?
Definitely. Investors will be watching closely to see if the costs from Trump's tariffs are starting to show up in consumer prices. If they are, that would obviously fuel inflation concerns and put more pressure on the Fed.
Okay, so CPI is a huge data point today. Before we wrap up, let's quickly hit a few other big headlines from the sources. It really shows how interconnected everything is.
Absolutely. Quite a few other interesting stories floating around.
First up, Elon Musk and Tesla. What was the latest there?
Yes. MarketWatch and CNBC reported Musk expressed some regret about social media posts he made targeting President Trump last week. Seems like that little feud is over.
What was the feud about again?
Apparently, Musk opposed Trump's One Big Beautiful Bill Act, worried about the deficit. Tesla stock took a bit of a hit during their spat, but mostly recovered.
Any other Tesla news?
Yep, Musk announced late Tuesday, via social media of course, that the robotaxi service is tentatively set to launch in Austin on June 22nd.
Robotaxi soon. But there's always a counterpoint with Tesla.
Always. Wells Fargo analysts, mentioned by MarketWatch and CNBC, are still pretty bearish. They're forecasting a huge drop, like 63%, in Tesla shares, citing weak sales concerns, even with the robotaxi hype.
Okay, moving tech giants, IBM hit a new all-time high. What drove that?
Quantum computing.
Okay.
MarketWatch reported the surge came after IBM announced really ambitious plans. They're aiming to build what they call the world's first large-scale, fault-tolerant quantum computer, IBM Quantum Starling, by 2029.
Fault-tolerant. What does that mean practically?
Basically, making quantum computing reliable and scalable for real-world stuff, like drug discovery. They claim it could be 20,000 times faster, using 200 logical qubits. Big claims, big ambitions.
Quantum sounds like the future. What about another potential future energy source, nuclear fusion?
There was news on that front, too, from Europe. CNBC covered a German startup, Proxima Fusion. They just raised about $148 million, Europe's biggest private fusion funding round yet.
What are they building?
A stellarator-based fusion plant, aiming for the 2030s. The potential is obviously huge, limitless clean energy, but the source also mentioned the ongoing debate about whether the tech is really ready for commercial scale-up.
And sticking with disruptive tech, AI's impact on jobs. The ChatGPT outage seemed to highlight something there.
It really did. MarketWatch reported that outage caused genuine panic for some people. Turns out something like 58% of employees use AI, many weekly or daily. People were literally posting, "I no longer know how to work."
Wow. And the job impact.
Sources like MarketWatch and CNBC are definitely looking at how companies might use AI to cut costs. There was that striking anecdote about 360 security technology in China maybe eliminating its entire marketing department with AI.
The whole department.
Yeah. And Google's recent buyouts were also mentioned in that cost-cutting context, possibly linked to AI efficiency. Meanwhile, Meta's pouring money and finalizing a massive $14 billion investment in Scale AI, according to CNBC. It's a huge area of focus and change.
We touched on the dollar earlier, but sources also specifically mentioned Asia shifting away from it.
Yes. CNBC had a piece focusing on that trend in Asia. It seems driven by geopolitics, monetary policy. ASEAN countries are pushing to use local currencies more for trade, trying to reduce reliance on the dollar and cushion against exchange rate shocks. Things like Trump's trade policy unpredictability might be accelerating this.
Any numbers on the dollar's declining share?
CNBC noted its share in global reserves has dropped from over 70% back in 2000 down to about 57.3% late last year. So a noticeable shift over time.
Okay, one last item. The legal status of Trump's tariffs. Are they still being challenged?
They are, but there was a key ruling. MarketWatch and Yahoo Finance reported a federal appeals court said the tariffs can stay in place while the legal challenges proceed.
So the challenge continues, but the tariffs remain for now.
Exactly. It overturned a lower court decision that questioned his authority. The main arguments are set for July 31st, so that legal fight over tariffs, which have caused so much trade disruption, is definitely ongoing.
Wow. That is a lot to process from just a few days of headlines. This deep dive really helped tie it all together, though. You've got this fragile US-China trade truce, the real pain tariffs are inflicting over there, the huge strategic game around rare earths.
Then you have the stock market rallying but facing headwinds and analyst caution, bond yields rising amid these big questions about U.S. debt and the dollar's future.
Which pushes investors towards gold and crypto, all while massive tech shifts like AI and quantum are happening in the background.
It's definitely a complex, interconnected picture right now. Trade, fiscal policy, tech, investor sentiment, it's all tangled together.
Well, we've tried to pull out the key threads from the sources we looked at today, hopefully giving you that shortcut to understanding these critical developments. So the final thought for you to chew on, with all this trade uncertainty, the debt worries, the moves into gold and crypto, what does this shifting landscape mean for your view of market risk and opportunity in the months ahead? Certainly something to think about.
Absolutely. These are the big trends shaping the financial world right now.
We'll see you all tomorrow morning with new headlines from major financial magazines.